Thank you very much, Victoria. I'm definitely a fan of yours and Daniel. So it's a pleasure to speak here at the EBC once more. So I will talk. So good afternoon to everyone else from Switzerland, from my home office. I have some slides to share, and let me put them up. So I'm talking about how to issue a central bank digital currency, and let's start again with what is central bank money, because that's important when we come to central bank digital currency. So currently, central banks issue two types of money, and those are here on this slide in blue. These are on the lower left banknotes you're all familiar with. That's when you can pay with a banknote. That's the only central bank money that's available for the public. The other type of central bank money is in the upper right. That's central bank deposits, but it's only commercial banks, basically, or selected financial market participants that can have an account at the central bank. These accounts are sometimes also called reserves, but they are not for the public. So only commercial banks can have them. Commercial banks themselves then again provide deposits for the public, and that's the commercial bank deposits that most of us use when we make payments. So that the type of money available for the public are the banknotes from the central bank and the commercial bank deposits from the commercial banks. And this is basically private money, while the banknotes is state money. Now, for the central bank to digitize its money, or tokenize its money as you want, there are two ways. Of course, you can either do that with the central bank deposits, and then you would get something called a wholesale CBDC. That would be something only available for the commercial banks. Or you could digitize the banknotes, and then you would get a retail CBDC. And already here you see, if the central bank would tokenize the central bank deposits, there is no competition here. It's only the central bank that can do that. That's also why the effects or the impact that you would have would not be that drastic. Why would you do that? Why would you do a wholesale CBDC? That you would do if the financial market infrastructure that we have nowadays would become DLT based. Then you need to get somehow central bank money on that financial infrastructure, and that's when you need a wholesale CBDC. That was, for instance, the pilot that we did, or the proof of concept with the Swiss Digital Exchange, the so-called Project Helvetia. You can all read about that on the website if you're interested in that. Now, much more impact would the tokenization of banknotes have, the retail CBDC. And that's also why central banks have been much more cautious with this, because you can see already from this picture, you would get into competition with commercial bank deposits. And one specific fear is if people would stop holding commercial bank deposits and put all their cash into retail CBDC, then you would have an issue that is often called the risk of disintermediation of the banking sector, namely that banks could lose a very important source of funding with possible adverse effects for the economy. Now, if you go into the literature on this risk, then you also find a lot of counter arguments. And I just give you a flavor here of these counter arguments. Some say, well, central banks could just step in and replace the deposit funding with central bank funding. So basically, these type of arguments say, well, it's not such a big deal. Central banks just provide the funding to the commercial banks. And then there are other lines of argument that say, well, actually, that could even be a good thing, because in order for the commercial banks to keep the funding, they would have to change their business model, especially they would have to become less risky, and that would actually improve the stability of the entire system. And then finally, there are third lines of argument that say, well, you know, we can just design it in a way that mitigates that risk, namely by making hoarding of CBDC less attractive, so that the retail CBDC is only used to make payments, but not as a store of value, not to hoard money. And you just do that, for instance, by making it less attractive. A negative interest rate would be one possibility, or you somehow limit the possibilities to convert bank deposits to CBDC. So you have, different opinions here in the literature. Another concern that some central banks have is that they say, well, what's really the value added of a retail CBDC? Nowadays, you have the commercial bank deposits. You can basically make all the payments you want to make. So why do you need it? Now, arguments would be, you can say, well, a central bank money, because it's a liability of the central bank, doesn't have a counterparty risk. The central bank cannot go bankrupt, and it doesn't have a liquidity risk. You cannot redeem or exchange it for anything else, unlike your commercial bank deposits, where the commercial bank can go bankrupt and where the commercial bank can have a problem in exchanging your deposit into, for instance, into cash. But of course, also here we have deposit insurance and so on. Another possible argument why a retail CBDC would be needed, you can say, well, there are additional possibilities. I mean, one of them would be that you can make payments on a blockchain. Others would be going much further, saying, well, you can start programming the money, but that's now something that is still far out there. A third issue might be privacy concerns, and you have some people who say, well, we do not want to have all this information about payments, what you pay, what you buy, where you are at a certain time of the day, to have that all centralized in a central bank. So these are different concerns here. Now, on the privacy, you also find actually counter arguments, people saying, well, it should be the central bank. We do not want to have all this data with a commercial provider. We rather have it with the central bank. So this is an issue that has many facets in the discussion. Now, I want to go a little bit deeper into that and talk about two different types of payment systems, namely account-based systems and token-based systems. Now, account-based systems, that's exactly the classical commercial bank account. And when you pay something here, basically you just credit one account, you debit the other one, and so that's how the payment is made. So what's important here, if you have an account-based system, if you make a payment through accounts, then you need the people that are involved in the transaction. You need to somehow identify them. You have to link them to the accounts in order to make the payment. Now, this can be real identities, but it could also be pseudonyms. You could have number accounts or something like that. But you need to somehow identify the people involved. In a token-based system, and think here banknotes, there the payment or the transfer occurs by handing over the token, the value itself, the banknote. And in such a payment, no one needs to be identified. You don't need to identify the payer. You don't need to identify the payee. You only need to be sure that the token, the banknote, is not fake, that this is real. So there are people who say in the digital world, this differentiation doesn't matter or is not applicable. But here I think there is a big difference, namely exactly what I said about this identity. So in an account-based system, also in the digital world, the question is what information is connected with the information asset. So in an account-based system, the asset, the account, is somehow associated with a transaction history. In a token-based system, the asset, the token, carries the information only about its value and the entity that issued it, but nothing about the persons involved in the transaction. And here an important point, I would argue that a distributed ledger is an account-based system. Just the difference to the traditional account-based system is that the ledger is distributed, decentralized, but you also have, for instance, in Bitcoins, that people are identified through their addresses that are made from the public keys that basically give an identification to the accounts. Now, how could we issue a CBDC? So along those lines, I mean, the most simple way to do it would be you say, okay, let's just have an account at the central bank for everyone. So instead of just having commercial banks having deposit accounts at the central bank, everyone could do that. So there are some proposals that go in that direction. There would be a very simple way to do it. The problem here is that the central bank becomes responsible for KYC, know your customer, and AML, anti-money laundering, and CFT, counterfeiting terrorism legislation. Now, you could say, okay, that could be outsourced. So if the central bank doesn't want to deal with that, it could be outsourced. Another concern with this system is exactly what I mentioned before. Mass surveillance would become extremely easy if everyone would have an account at the central bank. Now you could say, okay, the central bank is independent. It's not, the data will not be politically abused, but it could be a threat to central bank independence if the government or government agencies would like to have that data. And of course, the other thing is if you can open an account at the central bank directly, that's a direct competition to commercial banks. You can choose whether you want to have your account with the commercial bank or with the central bank. That's where I guess the risk of disintermediation would be highest. Now, the other way to do it would be a token-based CBDC. Now, the problem, if you have really a purely token-based system, is that given that it's a digital token, that you have to somehow ensure that this token cannot be easily copied. And that is something that is almost impossible to do. There are hardware-based solutions, but you can tamper with the hardware. And this is something that it's the double spending problem. That's very difficult to solve in a token-based system. The other difficulty in a purely token-based system is, of course, how do you apply these anti-money laundering, know your customer laws? That's exactly what you also see with cash. That's a challenge here. Now, the usual way to go that most central banks look at is, of course, to have a DLT, which is account-based, but it is distributed. The double spending is there taken care of through a consensus mechanism. Now here, the I guess well-known blockchain Trilemma, I think it was first formulated by Vitalik Buterin, that shows you the problem with the blockchain. This trilemma says that you have these three objectives: decentralization, security, and scalability, sometimes also efficiency, where scalability is. And you can only achieve with a blockchain two of these objectives at the same time. So the big issue here is Bitcoin chose decentralization. It's very decentralized, and security. It's very secure, but it's not very scalable. So these are the famous 7 transactions on the chain per second, while in a retail CBDC, you need 10,000s of transactions per second. Now, there are, of course, scaling solutions. That's the big issue. That's where a lot of work is being done at the moment. So there are different solutions to address this issue. The solution that most in industry blockchains have taken is that you just close the network. You have a closed network, not an open network like on Bitcoin or Ethereum. You have only a few nodes. It's a permission ledger, and that makes it much easier. You probably even know the identity of the nodes. You do not need a complicated consensus mechanism. So basically, you achieve scalability and security by sacrificing decentralization. Now, another way to do it is, of course, that's currently done, especially with the public blockchains. Ethereum is going through a big update right now. That is, if you try to change somehow the protocol layer, you change the consensus mechanism, you go from proof of work to proof of stake, for instance, you introduce sharding and so on. These are very interesting projects going on right now, especially with Ethereum. It will be interesting to see, but basically there you do not sacrifice decentralization, but you try to achieve scalability arguably by lowering a little bit the security. Now, a third way to do it is you change not the protocol layer itself, but you make changes at the second layer. And basically, very simply said, is you move stuff off the blockchain, or at least off the main chain. The Bitcoin Lightning Network would be an example, or roll-ups in Ethereum. Interestingly, if you look at what central banks are proposing for CBDCs, you have a combination of closed networks. These are permissioned ledgers, and they're also moving some of the retail stuff for all of the retail payments off the chain. So that's how to go. Now, a fourth solution, and that's almost heretical to say that at the blockchain convention, is to do it without the blockchain. I mean, it's good to have central bank money on the blockchain. You can issue it on the blockchain somewhere, just like, for instance, stablecoins are issued on a blockchain. But if you just want to do a retail CBDC, you do not need necessarily a blockchain. My understanding is that, for instance, the Chinese CBDC does not use a blockchain. You have an example in Uruguay that doesn't use a blockchain. So that's one way to go. And that's a proposal that we made, which is a working paper available at the website of the Swiss National Bank. It's done with my co-authors, David Schaum and Christian Gotthoff, and that has the same title as this lecture. So what we do there, we propose a retail CBDC that is based on David Schaum's original eCash idea. David Schaum, who is quasi the father of cryptocurrencies, the first one who had the idea to connect cryptography with digital money. Christian Gotthoff did improve together with his doctoral students that system, and we showed in this paper, how it could be used to issue a central bank digital currency. So what are the features of that proposal? First of all, it's centrally issued, so there is no DLT involved. What you gain with that is very high scalability and very high cost efficiency. So the trials that we did with that is you can make several 10,000s of transactions per second, and they cost you each transaction just I think it's somewhere around 0.00001 cent. So extremely cost effective, extremely scalable. Second, it's token-based, which allows you to provide guaranteed privacy for the payer. So it's not promised privacy, it's guaranteed through cryptography. But with the architecture that we propose, combined with KYC, AML, CFT compliance, and income transparency to promote tax compliance. I'll show you that in a second. Also, the way we propose it, it's designed to be really the equivalent of banknotes. So it should have no material impact on monetary policy and financial stability. It's not competing with bank accounts, it's competing with banknotes. And the fourth issue, not often discussed, we think it would be important for a CBDC to be implemented as an open source, actually as even going a little bit further, floss software. And the proposal we make is part of the GNU project. Most of you, probably economists and data scientists, know the GNU project through the software R. That would be an example. What you gain with that is you have transparency. You show the source code. It's also has security advantages through that, but also it encourages interoperability. People can use the code, they can change it, they can work with it. It's much easier to add to that. So that would be the proposal. And let me show you the overall big picture. And as I said, if you're interested in the details, go on the website of the Swiss National Bank and you will find the full working paper there. So overall architecture is like that. Let's start on the lower bottom left. So a customer would like to get a CBDC. So I said before, it's designed just like a banknote. So just like you go to an ATM to get your banknote, you would do the same here, meaning also you need to have an account at the commercial bank. So you can transfer your commercial bank deposit into the CBDC, just like you do it with your banknote. You need to have an account, and that's actually how we make sure that the KYC, AML, CFT regulation is taken care of. It's basically delegated to the intermediaries. They have to make sure that they have the information. But what's special about the proposal is if you withdraw your CBDC, then we use blind signatures. So the customer is blinding the coin. What the central bank does, the central bank provides key pairs that give you different values, 5 franc, 10 franc, or euro, or dollar, or whatever. You use these public keys that are published to make your coin, but it's the customer who blinds the coin, the serial number basically of the coin, if you want, so that no one sees what number that is withdrawn, and that that blinded number is then signed by the central bank. That's the blind signature. So no one can trace that number to that person withdrawing the CBDC. The customer then unblinds the signature, the coin, and can use it. If she spends it, no one can trace that coin back to her. Now, there's an incentive mechanism here. If the merchant receives that CBDC, the merchant, it's in the incentive of the merchant to immediately deposit it. Why? As I said before, tokens can easily be copied. The double spending in this scheme is solved by the merchant depositing the coin, and then the central bank is just checking whether this coin has already been spent. So the central bank keeps a list of already spent coins, checks whether the coin has already been spent. If yes, then the signal comes back not valid. If not, then it's valid. That's how the double spending issue is solved in that scheme. So there is no attempt to try to prevent people from copying the coin, but double spending is checked by the central bank at the time of depositing. Now, important here, that doesn't mean that you cannot receive coins without depositing, especially, for instance, in a situation where a parent gives a coin to a child. The child doesn't have to worry that the parent has already spent that or will spend the same coin somewhere else. The same with the state, the state that would give money to some money as a transfer. Also there, you could have people receiving such CBDC without having an account. And then when they spend it again, buy something, then the merchant would deposit it with his or her commercial bank. Now, let me stop here to have enough time to maybe get some questions.
Thank you very much, Thomas. Thank you. So I'll start reading a question here. So Lorenzo is now talking about from the perspective of the European Central Bank. How does the European Central Bank, for example, expect to counteract the effect of the global crypto market when they issue the central bank digital currency?
So I'm not familiar with the inner thinking of the European Central Bank, but I think all central banks are really studying the issuance of CBDC. And there are different ways to do it. I mean, most of the central banks look at somehow a DLT solution, but a permission ledger. There are different ways to do it. But in the end, I think, so my position is that you can do a CBDC without a blockchain, but blockchains in the end need CBDCs. And you see that from the big demand for stable coins. Stable coins wouldn't be in such big demand if customers and people wouldn't want to have some type of stable money on the blockchain.
Thank you, Thomas. There is a comment here from Paul. He says, the accounts should not be in the central banks or in the commercial banks. They should be on the infrastructure that all parties connect to, so ultimately owned by the individuals or companies that hold the assets. What do you think about that comment?
I think that's a very, that's a good proposal. That has been the original idea of Bitcoin. What you see is that, a lot of people do not want to be their own bank. That's a fact. Some do, and it's good if they have the possibility. but a lot of people want to have an intermediary to do all the things that they don't want to do. Also for convenience or for security reasons, a lot of people who hold Bitcoin, they are not running a node on the blockchain. They are buying a Bitcoin through Coinbase or another exchange. A lot of times they have the Bitcoin, someone else, a wallet provider is holding the Bitcoin for them. So that's a lot of people actually want to have intermediaries.
Mm-hmm. Thank you, Thomas. And last question. So Ricardo asked, what is the final role of commercial banks in the proposed scheme? I believe it's in your proposed paper.
Exactly. So there's, I mean, an important role, and the problem that we have in the DLT blockchain area is how to make sure that regulation is adhered to, and there might be some cryptographic ways to do it, which is difficult, but maybe we'll get there, that we can somehow embed the regulation in the tokens. But a very easy solution, that's what we propose in our paper, is to use the banks as intermediaries, being responsible for making sure that the regulation is applied. So that's one important role they have in our scheme.
Thank you, Thomas. Okay, we need to finish now, but the good thing is, Thomas, you'll be back on Wednesday in our panel on central bank digital currencies from the perspective of central banks. Oh. So, Thomas, thank you so much for your presentation today.